According to Realtor.com, for the week ending December 3rd, this is pretty recent, this is fresh, median listing prices were up 10% from the previous year. New listings fell 8%, and active inventory jumped more than 50%. Homes are spending about 9 more days on the market now compared with 2021. Now, all this as mortgage rates sit above 6%. Demand had dropped to multi-decade lows when we saw that spike above 7%. It's since recovered a bit, but the CEO of Equifax is warning that we're already in a mortgage recession, probably the deepest we've ever seen. Here to respond is Danielle Hale. She's chief economist at Realtor.com. Danielle, thanks for that data. And have we fallen off a cliff here or not? It seems more like a frozen market than a falling one.
Yeah, I think that's absolutely right. The housing market has pulled back in a big way, especially since, just a year ago, we were seeing some of the busiest housing market conditions that we've seen in decades, thanks to close to record low mortgage rates. So mortgage rates have adjusted to their highest level in 20 years, and housing activity is adjusting to correspond to those new pricing conditions for shoppers in the market.
I'm surprised to see Phoenix, Austin, and Denver with the most price reductions. What does that tell you?
Yeah, so those areas are seeing big increases in the number of homes on the market. They're in the West region. We have seen the biggest pullback in a lot of buyer interest in the West region. It tends to have higher home prices than other areas, and it's also very tied to a lot of those markets benefited from relocation as California residents were able to relocate during the pandemic, take advantage of workplace flexibility. Some of that is we're seeing a pullback in. And so those markets that had benefited from that relocation are starting to see activity slow. And that's where we're seeing the biggest adjustments, where homes are increasing and we're seeing that buyers have a little bit more negotiating power. Sellers need to be more mindful of buyer demand and adjust their expectations accordingly.
If there's one refrain I've heard lately, it's people going, I'm waiting for the housing market to crash so that I can buy. And what does that tell you about how different the psychology might be this time around than it was back, say, during the boom and bust cycle of 2006 to 2008?
Yeah, I think in 2006 to 2008, I think there was a widespread feeling that home prices couldn't decline. And we, of course, know that that's not true. It has happened in the somewhat recent past. I think that actually is a big help for the housing market. People have bought with that mindset of knowing that today's value might not necessarily be what a value is in the future. And so I think that makes the market a little bit faster to adjust, a little bit more flexible. But look, we've had a huge run up in mortgage rates, and that has changed the purchasing power for a lot of home shoppers. And so it makes sense that the housing market is going to have to adjust to those new conditions. But to go back to things that are different about this housing market compared to 2008, for example, we're looking at homeowners sitting on record levels of home equity, not just in total dollar amount, but relative to the value of real estate. So the homeowners in aggregate have about 70% of the value of their homes in equity. Back in the early 2000s, that number was closer to 60%. So homeowners are in a better position today than they were roughly 15 years ago.
They are so long as prices don't fall. Do you think that in 2023 prices could fall and wipe out some of that equity?
So home prices could fall. Our base case forecast is that home prices will actually continue to increase because we've seen such a huge run up in prices, even late into 2022. We're starting to see some moderation in the rate of growth, but ultimately home prices are still growing. You quoted our weekly stat. Home prices are still up 10% relative to a year ago. We expect them to moderate to about half that, so 5% for the year as a whole in 2023. Even with that moderation, even if home prices were to decline, homeowners would still be in a better equity position than they were in 2008. So I think it's a really different market thanks to the fact that lending practices have changed so much over the last decade and a half.
So what would you say to those friends, colleagues, neighbors, folks that we've heard from who say they still want to buy? Maybe they can't afford the place that they want to purchase and they're hoping or waiting for a price correction. Are they going to get one?
So our expectation is no, certainly not in 2023. We have seen home prices soften a bit, so they're not growing at the same pace. And in that sense, it makes it a little bit easier to keep up with the housing market as a buyer. But if you're waiting for a crash, I don't necessarily think that's the best way to make a decision. We don't know what's going to happen to housing in the future. We have some educated guesses based on what we've seen happen in the past. I think the right way to approach the housing market as a buyer is if you find a home that fits your needs, it meets your budget, and it's available, and there are many more of them available right now, then it's the right time for you to make a move. You don't know exactly what's going to happen in the future, but as long as you're checking those boxes and making sure you're setting yourself up for success, not spending too much on your mortgage payment, making sure you have a good savings cushion in your, left over after you make the home purchase, I think then it's the time to make a move when you're ready, whether or not the market conditions have shown that home prices are declining.
All right. It's like trying to time the market, but for something even more important. Danielle, thanks so much for your time today. Great to have you.